Alrighty guys, welcome back to another video today here on the channel. We got another red day in the market, but we also have Mona Mahajan on CNBC. She says, we think this is the beginning stages of the new bull market. Alright, so this isn't a correction. Well, it is a correction. She doesn't think this is the beginning of a downturn. She doesn't think this is the beginning of a long-term correction. And she's going to give some thoughts and opinions. So let's get on into it.
It's after yesterday's sell-off. Joining us right now is Mona Mahajan. She's the senior investment strategist at Edward Jones, at the table no less this morning.
Great
nice
to be here.
We were on a run, then we were not on a run, then we went on a little one, then we went down. What's really happening here during this crazy earnings season?
You know, it's a great question. And look, we have had a tremendous rally in the first 8 months of the year, call it. S&P 500 went almost up in a straight line from March to end of July. Now, we were hit with not one, but two downgrades. Fitch last week, Moody's just a couple of days ago, and yet the market's down about 2 to 3% off its high. So everybody is waiting for this notorious pullback, a period of consolidation, some profit taking, but
she is making a good point. We have gone up so straight, so long, that it's time for a pullback. And what makes it a better time than to have two big downgrades?
Keep in mind, there is a lot of cash on the sidelines. We know about the CD money and on the retail side, and institutions have that cash waiting as well, ready to deploy. So what we're seeing is 2024 looks like a decent setup. Not only can we see a Fed on the sidelines, potentially moving lower, inflation continuing to moderate, but earnings, we think, improve next year as well. So that's a pretty good backdrop, we think.
That is a pretty good thing to have behind us. We've got the Fed hiked so much they should be loosening. We've got so much money on the sidelines that people are going to start getting more FOMO. They're going to start putting their money in. And we're on the way down now after a super healthy leg up. That's the perfect recipe for another leg up to keep going longer.
For risk assets.
So 12 months out, though, what do you think the prospect is for a higher market? I mean, in a world where some people think we already went parabolic.
Yeah. Look, we think the market is in the beginning stages of a bull market phase, and bull markets tend to last, 3 to 4 years on average. Now, that's not to say markets go up in a straight line forever. There are, on average, any normal given year, 1 to 3 corrections, 5 to 10% range. We have only seen one about 5 to 7% correction during that March financial crisis period. So we do think, look for some volatility, but use that volatility as an opportunity to, we think, position in both equities and bonds, really.
But why should the markets have a higher than historic valuation, historical average valuation, at a time when interest rates are not 0%? I mean, what is?
Because the markets are always forward-looking. We've got AI driving the world, going to power everything, and apparently just going to be such a big revolution that we can get by with printing $3 trillion.
Is that case? Because everybody mentions this cash on the sideline, but what is going to cause this cash on the sideline to come out and pay, a premium multiple for the S&P 500 in a time when theoretically we shouldn't have a premium multiple given some of the headwinds?
Yeah, look, it's a great point. And of course, we can talk about that Magnificent Seven versus the rest of the market. And we look at it that way, Magnificent Seven, about 28 times next year's earning. If you look at that 493 that's left, about 16 and a half times. So much more reasonable valuations, we think, in the broader market. And so we do think where the opportunity will lie over that next 12-month period is in a broadening out cyclical parts of the market. Think about some parts of the bond market, but also think about international as well. So areas that are much more reasonably valued, we think, have that opportunity. Now, don't wholesale sell out of your AI and tech stocks. We think that's at a beginning phase of a long-term market, but fully valued at this point.
So if that's fully valued, though,
I'd say that's a reasonable statement, that the Magnificent Seven are fair or overvalued, getting towards overvalued.
So you don't think that there's going to be a rotation out?
So
because I think that there could be, and
we've started to see it.
Right. No, but if you get into a rotation situation, the idea of holding the guys that you think are at the beginning of this thing may actually be the mistake.
Well, we think that there probably is going to be some period of consolidation in those Magnificent Seven. Large cap technology broadly, natural to take some profits after a nice run. That doesn't mean their run is over. It means that, for now we could see that market shift to the broader parts of the market, the cyclical parts of the market, where the economy, levered to an economy that's doing well. But longer term, that valuation will catch up to the earnings potential. And we do think
okay, so I always get emails from viewers who say, don't just tell me stocks, I buy mutual funds, I buy ETFs, I buy indexes and things. What would you do in that regard?
Yeah, absolutely. Look, ETFs are a low-cost way to play the market. You can't go out and buy 500 stocks on your own. So we do think there's real value in the ETF space and in some mutual funds that are actively managed. When we think about good opportunities for active management, maybe not large cap technology or large cap stocks, but small cap stocks, parts of the bond market, really good areas where mutual fund managers can get an advantage. So certainly we think there's opportunities there. And we think about bonds, longer duration starting to make a lot of sense here as well.
Alrighty, guys. So basically, just to sum up the video, we have got the Fed going to start easing rates or pausing soon. That's going to be a backdrop. We've got so much money on the sidelines that has to come in and go somewhere. Bonds are coming down, so it's not going to go into bonds. Stock market. We have a huge first leg. Everything's kind of overextended. So welcome a pullback. Let's welcome a pullback. And then when we get this slight 7 to 10% correction, we'll put the money in. We'll buy the dip. That'll be another set of people, the buy the dippers, that are holding the market up. And then AI on top of everything, making every single business more seamless and more profitable as time goes on. And then not to mention the small caps that still need money to come in to meet their valuations to raise up the S&P 500 to meet its valuation. So guys, we've got a lot of money to come in, a lot of backdrops. We've got a lot of bad news and a lot of good news. But I think it's shaping up to where the bad news is kind of getting behind us. We've kind of gone through the worst 2-3 years you could possibly imagine without having a financial recession or a depression or the world shutting down. So we've dodged some major bullets, and this is not the time to panic. Maybe back at the lows, but if anything, even if we have any type of correction, regardless the percent, it'll be a higher low, and that's bullish long term. So anyway, those are my opinions on the market, guys. I hope you enjoyed the video. Make sure and like the button. Make sure and hit the like button. Subscribe if you haven't already. We're going to be doing this every day on the channel, guys, so make sure and ride along, and I'll catch you in the next one. Peace.